You want to invest. Being a smart person, you know that you need to do research on any investment before you actually invest your money. However, you are a busy person. You don't really have much time to do in-depth research on any potential investment. You wonder if there is a simple but effective way to invest your money that doesn't take up too much of your time and effort. And the answer is yes, there is. One such investment method is known as dollar cost averaging. Dollar cost averaging is when you invest a specific amount of money into an investment asset at a regular interval. For example, you invest $100 into Facebook shares every month. The main idea behind dollar cost averaging is essentially to manage the price risk of the targeted investment asset. Prices of investment assets will always fluctuate, and such fluctuation is more pronounced in the medium term and even more so in the short term. Hence, the dollar cost averaging method removes the need for you to time the market. In other words, trying to find the lowest price point before entering. Timing the market would require a lot more detailed research, is more psychologically stressful, and has low probability of being accurate. Generally, over the long term, dollar cost averaging should bring you decent investment returns. This is because by buying the investments both when the price is high and when the price is low, you will have averaged down your cost of investment. For example, let's look at what happens if you invested in the shares of Bank of America from January 2008 until October 2021. This is about 13 years and 10 months, or 166 months of investing in Bank of America shares. If you invested every month from January 2008 until October 2021, the average price you pay per Bank of America share is $20.29. If you invested a lump sum in January 2008, and assuming that you did not add to your position since then, the price per share is $44.15, which is more than double the dollar cost averaging price. And when it comes to investment returns, over the same period, dollar cost averaging gave you a return of 134%, while the lump sum method only gave a return of 7.5%. However, do keep in mind that there is a huge gap in returns because throughout the investment period, the share price fell and then recovered. If you were to invest in a different asset, the divergence in returns would look different. If you had invested in the shares of Amazon over the same period, the returns between a lump sum investing approach and the dollar cost averaging approach may not be that much different. Likewise, if you had invested in the shares of BlackBerry over the same period, both methods will ensure that you lose money. This brings us to one important point. Although dollar cost averaging is a simple method and requires less effort, it is still an investment method that requires you to research which investment asset is suitable for you to apply dollar cost averaging to, and continuously monitor your investments to ensure that they are still profitable. As mentioned in a previous video, different people will have different investment styles. Dollar cost averaging is just one style or method for you to consider and decide whether or not it is suitable for you. Investing is essential. Whatever your circumstances are, you need to discover which investment style is suitable for you. Dollar cost averaging is one style for you to consider.